Hello, everyone. Welcome to this Friday on the Final Bar. We will talk about the bear market rally. That is correct. I'm terming it a bear market rally, and I'll share with you in the course of the show today why I think it's fair to describe it that way. But there's no denying the strength that you're getting out of the recent lows. Yesterday, accelerating to the upside. Today, continuing, closing near the highs of the day with the S&P just below 43.85, led by materials. Ladies and gentlemen, this is the Final Bar. Hello, everyone. Welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a sunny Redmond, Washington. Thanks for joining us every weekday after the close as we break down the activity in the markets using the power of stock charts, using the technical analysis toolkit to better quantify investor behavior, to better understand market dynamics and respect the lessons of market history. And if you've looked at the history of the financial markets in terms of bear market phases, you will know that bear market rallies can be relatively painful. I actually made a comment yesterday. I think there's nothing more painfully bullish than a bear market rally, and I stand by that quote. There's a reason why bear market rallies are so tempting and why they're so seductive and why so many people are drawn in, and that is the reason why they bounce so quickly. Days like this where material stocks are up over 3%, where healthcare is up over 3%. Technology is the worst of the 11 sectors, and it's still up over 1%. This is certainly a market in a short-term risk-on mode. But what you have to remember is there's a difference between a short-term bounce after a big bombed-out week, digesting some pretty severe geopolitical activity, versus something that's more of a sustained rally, right? A lot of the headwinds, a lot of the challenges that we've been talking about, a lot of the uncertainty didn't just go away in the last 48 hours in the last two trading sessions. This is a bit of a reaction to what we've seen. There's a lot of game left, as I was told early in my athletic career, which is certainly behind me. Let's talk about the schedule we have coming up. We had some great guests this week. We had a lot of fun talking with some of our guests and breaking down some of the recent moves in the market. Next week, we have three great guests for you. On Tuesday, the 1st, we have Dale Pinkert from Forex Analytics. On Wednesday, the 2nd, Craig Johnson from Piper Sandler. On Thursday, the 3rd, John Gagliardi from Fidelity joining us on the show for the first time. Also, just earlier today, we broadcast our latest episode of The Pitch. I caught up with Grayson Rose just a couple hours ago after they did the recording, and talked to me about that experience. It was a lot of fun with Tony Zhang, Mark Newton, and John Kosar. Did a great job. And there was one ticker, first time since we've done The Pitch over a year now, the first time we had two of our panelists pick the same stock. Check out the episode to see which stock that was, because I think it's an important one. Go to stockcharts.com/thepitch to see that episode and all of our previous episodes as well. We go on to our next main segment called Wrap the Week, which is where we focus on how the week has evolved, focus on last Friday to this Friday. I want to start with a poll question, though. We asked you recently, which of the generals performs best over the next 3 months? And this came from my experiences at Fidelity in the Fidelity chart room. They had a chart called the Generals. It wasn't in the room, it was from an old room, and it was in the archives of the Fidelity chart room where they looked at General Electric, General Motors, General Reinsurance, and all of these names with General. And the idea was these big mega cap industrial companies that were important to follow back in like the 70s. And so I updated that with four stocks: General Electric, GE, General Motors, GM, General Mills, GIS, and Dollar General, DG. The votes are in, and the majority or the plurality, the most common response was General Mills, GIS, followed by Dollar General. Let's look at those charts really quickly here. I don't have them readily available in my head, so let's look at the four. So this is General Electric, obviously a big industrial name. And what's interesting about the chart of General Electric really hasn't gone anywhere, right? It peaked out in March of last year, hit it again in June of last year, hit that again in November of last year, And it's really been fairly stagnant, which is why the relative strength has been so underwhelming. So I'd probably give a thumbs down to that one, having not seen the other ones. General Mills, like a lot of the other automakers, has been rolling over, similar to General Electric, sort of topped out last year and has never really been able to power through those previous highs. It looked like it might be doing that in early January, but sort of given that back. And now it's at the lower end of the range. I could see a tradable bounce from current levels, bouncing off of support, but overall, I'm not a huge fan of that space as well. General Mills is the third one. Having not, I know what the Dollar General chart looks like because I was looking at the dollar stores yesterday. So I would say General Mills probably would be my vote as well. And it's in a fairly defensive sector. It's a fairly higher yielding name. You get a 3% dividend yield right now. And this is a stock that had a really good run. You could argue this is a bit of a bull flag pattern, which is where you have a big run higher and then a short-term downtrend, a parallel highs and lows. You break up through that pattern to the upside, which it's very close to doing. And this all of a sudden looks like a fairly constructive chart. The relative strength has been improving in the last couple months. Dollar General, so the dollar stores, similar to GM and the automakers, have rolled over. The dollar stores, though, even more so, have undercut their lows from last fall. And while they're bouncing today like everything else is, bounces like this happen when the market's really deteriorating. You want to see something like a higher low to get a little more buy-in to this sort of market move. So that is I agree with the crowd here. GIS makes sense right here. We'll see how those names continue on. Continuing on our Wrap the Week segment, let's look at our Wrap the Week chart. And so this is a chart that looks at major asset classes, all using ETFs. We had a shortened holiday week, so we're starting last Friday with a Monday holiday this week. Then we have Tuesday through Friday. So this is where the week ended up. Even with the rally in the last couple of days, the S&P really only up 0.7%, 0.8%, we'll round it up to there. A number of things underperformed the S&P. The dollar index using the UUP was up 0.5%. The rest of these were down for the week. The GLD, gold, down 0.3%. Now, this is after gold has rallied pretty well. This is giving back some of those previous gains. In red, we have the TLT, which is a long bond ETF, down about 1%. This is Bitcoin, down about 2.3%. And in orange, the worst performer, emerging markets, down 2.8%. These other asset classes outperformed the S&P this week. In pink, we have the Nasdaq 100 up 1.3%. In purple, small caps up 1.5%. Crude oil, the best performer. This is using the USO, which finished the week up 1.6%. So what's interesting is you have something like crude oil, which is more of sort of a commodity play, a nice run and pulling back a little bit today. A lot of these other sort of risk-on assets really reverting to the upside. This is obviously selling off quite a bit in the middle of the week as we're all digesting the news from the Ukraine, Russia, and all the potential ramifications of that. There's been sort of the initial reaction to that and then a bounce higher. One of my friends, Matt Maley from Miller Tabak, shared a quote, and I'm completely going to butcher this beautifully articulated quote that he had, so I really apologize for that. But it was something like the general thinking around military actions around wars is you sell when you hear the war drums and you buy when you hear the first shots, is something like that. I'm paraphrasing, but basically the anticipation of a war happening usually puts a lot of downside pressure on stocks. Once things happening and when there are boots on the ground and things are actually starting to play out, usually the negativity has often been priced in already. So we're certainly seeing this week play out kind of the normal wartime playbook for stocks, although this is obviously a very compressed time frame and it's anecdotal at this point. I would say the ripple effects of what is happening, it's an ongoing event. It's still very much up in the air. And what concerns me about this is the markets tend to appreciate certainty. They don't tend to appreciate uncertainty. I don't feel a lot of certainty right now. I feel a lot of speculation. I feel a lot of uncertainty. And I see what's happened in the last couple of days is more of a reaction to the fact that we sold off so significantly, as opposed to things are great, it's a green light, let's ride the S&P back up to 4,800 starting on Wednesday. I'm not getting that yet. And I'll share with you as we get to the Mindful Investor Live chart list why I don't think that's necessarily the case. So to continue to wrap the week here, we'll go to the Mindful Investor Live chart list. This is a list of charts that I keep updated on StockCharts at all times. The way you get to this list, by the way, if you're new to the show, is if you go to articles at the top of the StockCharts website, go to my homepage, which is called The Mindful Investor. You'll see a link at the top of that page to get to this list of charts. I keep them updated, and you're welcome to take them, copy them to your own chart list or do whatever you like. We'll start with my market trend model. This is a model I've run for a number of years. I've tweaked it at times, but fairly consistent, and it tracks the S&P 500 on 3 time frames. The long term, which I think of as sort of a year plus, medium term is a couple months to a year, and then short term is a couple days to a couple weeks, is the general way I would summarize this. The long-term model turned positive in June of 2020, remains positive, although certainly it's been sloping downwards. It needs to cross the 0 line to turn real negative. It's only been negative twice in the last 5 years, during late 2018 and during early 2020, during those deeper drawdowns. Medium-term model had been negative since May of 2020, turned negative once again in January of this year, and remains negative to this week. And so when I see a move like I did today and yesterday and today, I have to reflect on the fact that my short-term model still remains negative because we're below the 5-week exponential moving average. My medium-term model remains negative. And so overall, I want to think of this. The model tells me to think of this as a bear market rally until those models shift, until it tells you that there's enough of a bounce, a sustainable bounce, to trigger the model. The reason why you use weekly data and you use longer term moving averages is to minimize whipsaws. You don't want it to signal every time there's a bounce higher or lower. You want it to recognize a shifting, a change of the ties. I would argue we're not, while this bounce in the last 2 sessions has certainly been fairly significant, it's been quick and it's been a nice move to the upside. I still see this as lower highs and lower lows until we change that pattern, and we haven't yet. It takes us to the chart of the S&P 500, and when I'm looking at this one, I have to think about the overall change of character in this market. I think the market was in rally mode really through November. The market continued to rally in the form of the S&P through the end of last year and into January, but a lot of indexes actually never made another new high, and the advanced decline lines, the breadth measures, all made lower highs, or many of them, some of them made lower highs going into the beginning of the year. The NYSE advanced decline line, which we'll look at here in a minute, the momentum has been deteriorating. Every swing higher in stocks since early November has seen less momentum. It's seen a lower momentum reading. And so most recently, I'm looking at a lower low. I'm looking at a lower high until we make a higher high. And so at this point, this is still a downtrend, right? A downtrend becomes an uptrend when you see a higher high and you see a higher low. By the way, while I'm thinking about it, I just wrote an article a couple hours ago. If you go to the articles page, I put this article out called Playing Price Swings and the Risks of Leverage. I'd encourage you to check that out. I talk a little bit more detail about some of the conditions that we're seeing right now in terms of what conditions I would see or I would expect to see that would convince me that we have indeed rotated from a bear market rally to more of a sustainable rally. And the quick version is you need a higher high and a higher low. Those are 2 of the things. We haven't seen either of those things yet. So at this point, I'm treating it more like a bounce off of the first Fibonacci support, a reaction to the fact that we've been so beaten down for quite some time. We did have a bullish momentum divergence. I think given the strength you saw today, you can validate the fact that this was a bullish divergence with lower lows and higher lows in the RSI. That all tells you can rally. The question is, how much do you rally from here? From here, I'm looking at 2 key levels, the 4460 level, which is the 200-day moving average, the 4600 level, which was that swing high in February. When we didn't make it above that swing high in mid-February, that was one of the indications that this was just a short-term bounce. I'll be looking for a similar sort of pattern going forward here into next week. Now, when we talk about breadth, we can look at how the breadth conditions have deteriorated, but really what we would need to see to turn more constructive on the current market environment. Now, a lot of this data is not updated yet for today's close, as we're doing this right after the close, and our system process a lot of that data after the close. So it'll be ready a little bit after the show. So worth revisiting maybe over the weekend. But at this point, it's probably not going to change a ton in terms of the overall trend of these. And so when I'm looking at the chart of breadth conditions using the advanced decline lines, I'm seeing the NYSE advanced decline line in a clear downtrend of lower lows. I'm seeing the mid cap and the small cap advanced decline lines making new lows in the last week. All of that's not bullish. The S&P 500 is the only one that hasn't undercut its December low just yet. All the other ones have. So while the S&P advanced decline line is still kind of hanging in there, the rest of these have all sort of broken down. So when I think about the potential of the markets to move meaningfully higher from here versus meaningfully lower, I still would say the tendency, my thought is the tendency is still lower over higher is the more likely path given the deterioration that we've seen. I don't see a capitulation in those indicators just yet. When we're looking at percent of stocks above key moving averages, this is a really interesting one. I think the one I'll focus on is this one, the S&P and the percent of stocks above their 200-day moving average. What happens in a bull market phase, right, when the market's in a strong environment, most stocks are most likely above their 200-day moving average. That's the sign of a healthy market environment. You can see from mid-2020 through most of actually the entire 2021, and then sort of changed here at the in January of this year. That entire time, over half of the S&P members were above their 200-day. And that makes sense when the market's in a bull market phase. When this gets below 50%, particularly when it remains below there, when you look back in market history, this is when things are more in a bear market phase. This is when it's a longer, more drawn out corrective price action, because when less than 50% of the market less than 50% of the S&P 500 members are above their 200-day. That tells you a lot of stocks have broken down through a key long-term barometer, a key measure of whether a stock's in an uptrend or a downtrend. So just like the S&P remains below its 200-day, most stocks, about 2 out of 3 remain below their 200-day moving average as of yesterday's close as well. It'll probably bounce up a little bit, and certainly the percent of stocks above their 50-day could bounce up a little bit, given the strength that you saw today. But overall, the longer that this spends below 50%, that pink horizontal line, the less and less optimistic I would be about the prospects of the market, meaningfully rallying from here. We can certainly have a bear market rally. Those can be sudden and severe. And the rally that we had in late January was about 8 or 9% off of the lows on an intraday basis, about 6 to 7% on a closing basis. We're not there yet. That could tell you next week could have a nice continued bounce there. But the question is, how sustainable? Should that be an opportunity to take on more risk, or an opportunity to re-engage shorts and to get more cautionary and to unwind short-term plays that you've made? And I would tend to think more of the latter until the market convinces you otherwise. We need to take a quick commercial break. We'll be back answering your questions from the Final Bar mailbag. We'll see you in a minute. Hey everyone, welcome back to the Final Bar. Thanks so much for joining us every weekday after the close as we break down the market environment using StockCharts, using the technical analysis toolkit. Now, as you are using your own charts, questions are going to come up. How do you analyze a particular indicator? How do you make sense of a particular chart, particular stock or ETF? And we are here to help answer your questions on technical analysis, behavioral finance, market structure, whatever it is. You can email us your questions at thefinalbar@stockcharts.com. We're on Twitter at FinalBarSCTV. We're on YouTube. Just put a comment below the video you're watching on our StockCharts channel. We'll gather all those questions and hope to answer one of yours in our next mailbag segment, which will be Tuesday of next week. Also, go to StockChartsTV.com. That is our on-demand platform. It is completely free. It's fantastic. Special events like The Pitch. Larry Williams put out a recent market outlook, which I'd certainly suggest you look at. Martin Pring and others did a year preview back in January, which are worth paying attention to in terms of big picture themes, and all the great guest interviews that we have every day. Go to StockChartsTV.com, or on your mobile device, just search for StockCharts TV on demand. Our next segment is the Final Bar mailbag. I love hearing from all of you. And listen, thanks so much for supporting us, supporting the show and StockCharts TV, but sharing your questions. We really appreciate it. It helps us think about where to focus our content. Let's get to the first question. Do you consult your weekly or intermediate charts before the daily chart when considering a new long position? And the short answer to that is absolutely. In the course of this show, and we have 30 minutes together, I'm usually very quickly, very rapidly, and at times probably talking way too fast as I try to cycle through as many charts as possible. And in reality, I think a deliberate, thoughtful investment process, particularly if you're a long-term investor, should be pretty well structured and for lack of a better term, be boring, right? It should be a lot more of thinking about longer term trends and reflecting on the evidence that you're seeing and try to make sense of how you should be positioned based on those assumptions. That means looking at different time frames. So when I'm talking to my market misbehavior premium members, we look at weekly charts, and even monthly charts, right? I have a weekly report where we review some of the weekly data, a monthly report where we look at some of the long-term trends, and those pieces I don't really get into on this show because we're trying to just recap what's happening in the markets and connect it to those long-term trends. But in reality, in my own investment process, I've spent a lot of time, arguably a majority of my time, thinking about that longer term time frame, sort of the long term and medium term time frames that I would talk about. So absolutely, even if you're a short term trader, I would start with longer term data, because you have to remember that the interim, the short term data that you're actually trading is part of a much longer term picture that you want to understand. So that the short answer is yet, and there's the yes, and there's the longer answer for you as well. Next question. I periodically hear values associated with fund inflows and outflows into a sector or total market. Do you know what they're talking about and how it's computed? Is there an index or indicator that shows new money entering the market and how much money is on the sidelines? So there are a number of ways to answer that question. And yes, I'm familiar with that. And I would say particularly institutional investors pay a lot of attention to what we call fund flows. And traditionally, that was mutual fund flows. And I don't have a chart to show you because honestly, on StockCharts, we don't track a lot of this data because usually individual investors don't pay a ton of attention to this. It's more institutions. So we would get brokers that would write research on that. I remember getting reports from like B of A and others that would talk about fund flows. Usually when I think about data that we would get, ICI, which stands for like Investment Company Institute or something kind of like that, would do weekly fund flows data. So we would see flows in and out of domestic funds, global funds, international funds, and equity versus bond funds. And we could think about how investors are rotating between those things. But Morningstar, if I remember right, has fund flow data that they share. Lipper has fund flow data, all based on mutual funds. You can also look at ETF flows. And I know Bloomberg, I've used Bloomberg before where they have data tracking flows in and out of ETFs. And there are other independent providers that try to track that data as well. In terms of what would I suggest, to be honest with you, when you think about like the Ridex, flows, this is something that we have as part of our sentiment, my sentiment list that we share. When I'm looking at Ridex flows, this isn't necessarily flows in and out of the markets, but you could do that if you look deeper in the Ridex family. This is actually looking at people rotating between offensive and defensive. And defense is basically cash and cash-like flows. So when you're looking at that ratio going up or down, this is basically whether investors are rotating to the risk-on part of the Ridex family or the risk-off part of the Ridex family. So if you assume people are keeping their money in that fund family and just rotating around, that's kind of what we would do. And I should mention when I was at Fidelity, we would have great internal data about what flows we could track in terms of where people were betting. So the short answer is yes, there's data out there. We don't have a lot to share with you on StockCharts. I would say the Ridex flows, which is the part of the sentiment picture that I share, does address that. And that's probably the main way at this point that I would illustrate to you. I have made a note though, and I appreciate you sharing that. We don't have some of that data that I mentioned earlier. I'm going to take a look and see how hard it would be for us to incorporate it into the platform, because I think it'd be pretty cool to do so. Next question. Instead of simply following the S&P 500 and the Nasdaq, I began following these tickers: $SPTMI, that's a total market index; $WLSH, which is the Wilshire index; and what's the next one? IWV, which is like a big... Yeah, the Russell 3000. So that incorporates the Russell 1000 and the Russell 2000 as one big mammoth index of 3,000. It's actually less than 3,000. Is that right? Actually, might be 3,000 stocks, to be honest with you. I don't know. That provide more representation of the very broad market as a whole. However, given that almost no one is talking about these tickers, I wasn't sure if I was on the right track. So, really interesting question. And from, if you followed this show and you see how I approach the markets, I'm usually talking about the S&P, the NASDAQ 100, the NASDAQ Composite, maybe the Russell 2000. That's usually it for major indexes. And the reason is because I tend to feel that you get a good enough read on the equity markets by looking at those major indexes. That's one thing I would say. The second thing I would say is something like, SPTMI, which is the S&P Total Market Index. This is an attempt to sort of take all stocks and put it into one thing. To be honest with you, if you look at the S&P and then you look at the Russell 2000, the Russell 2000 is going to be kind of similar to this, because what happens is you're incorporating all the other stuff. The S&P, those major indexes, are kind of weighted to the mega cap stocks. Those are the big names. And I should also point out the other reason why you look at those is because most passive investment products, most passive investors are not allocating to a total market index. They're allocating to the S&P or the Qs or the diamonds or some, sort of mega cap focused index, or they're doing it to the Russell 2000 or a small cap index, and I'm tracking that already. So while the total market index or the Wilshire 5000 or whatever it is gives you a broader universe, I don't think you're necessarily getting a lot of additional data that you would be elsewhere. Now, looking at equal weighted indexes like that, something like the value line arithmetic or the value line geometric indexes, averages, I think absolutely that tells you a little bit more about some of those other companies, some of the smaller stocks, and how that relates to the mega cap indexes. Also, things like the equal weighted S&P, which I actually am sharing as part of my 3 and 3 here in a few moments. So yes, you can certainly look at those. I don't know how much additional information you're going to get relative to what you'd get by looking at like large caps versus like the Russell 2000. But again, at the end of the day, look at whatever's going to help you understand the market environment a little bit better. Final question, then we're done. Is IOO in an unbroken uptrend? I actually don't look at this ticker ever. What is it? This is a global 100 ETF. That's interesting. I actually don't follow this one very readily. And their question is this in an unbroken uptrend? That's a super subjective question. Would I say it's in an unbroken uptrend? No, because depending on how I would draw this trend line, I feel like any trend lines I would have drawn have been broken. It's also broken both moving averages that I track. So, by my definition, no, I would argue that's broken. But depending on your time frame, it could or it could not. I was told early in my career, there's a reason when you bring up a chart that trend lines aren't automatically on your chart. You have to draw them because it's a subjective analysis. I was told by one of my early mentors, trend lines are how you have a conversation with the markets. I love that way to think about it. And one of my analysts that I used to manage, Mark Dibble, is a fantastic analyst at Fidelity. And very successful over his career. His charts are filled with little lines that help him make sense of things. So I would encourage you to draw lines all over your charts. Whatever's going to help you understand the trajectory is effective. And for me, I would say no. It is a broken uptrend for me. We need to wrap the show. Go to the 3 and 3 today. It's brought to you by Chaikin Analytics. If you go to StockCharts ACP, in the bottom right corner, you'll see a little plug icon. If you click on that, Mark Chaikin did a really good job incorporating the Chaikin Power Gauge directly into StockCharts ACP. So check it out. Our first chart in the 3 and 3 is the S&P looking at percent of stocks above their 200-day and the 50-day. I talked earlier in the show during our Wrap the Week segment about the breadth conditions, how they've clearly been deteriorating for quite some time, I would argue. The longer that the S&P remains in this situation with this indicator remaining below 50%, the brief pullbacks have had this indicator remain below 50% for a very small amount of time. The longer it remains below there, the less and less it looks like a viable bounce, and the more and more this market looks like previous, longer, more drawn-out corrective phases, like in 2020, like in 2018 at the end of the year, like 2015, 16, and so forth. And if you look back in market history and take this chart and draw it back a little bit deeper, you'll see what I mean. So I'm concerned by the fact that less than 50% of the S&P stocks are above their 200-day moving average. Chart number 2, looking at growth versus value, is a nice bounce in growth stocks. And I highlighted yesterday the bullish engulfing pattern on Microsoft. You had charts like eBay with a nice, or Etsy with a nice bullish engulfing pattern bouncing today. And it's impressive to see those short-term bounces. But again, as a long-term investor, I'm thinking of this chart in the back of my mind, which is showing you the rotation away from growth and into value. And that really started in late November. That's where this ratio peaked out. That was the peak performance of growth over value. From there, it's been very much value over growth. And even with this week, with the little bounce, you're still in a downtrend. And I think this chart's in a downtrend until proven otherwise. So even with the bounce you have going into the weekend, it's still favoring value stocks over growth. And I think that's about right. Finally, the equal weighted S&P versus the cap weighted S&P. This is a great way to measure the strength of the mid and larger cap names, sort of the smaller companies within the S&P versus the big mega cap FANG-like stocks that you know. The fact that this ratio keeps going higher means the equal weighted version is outperforming the cap weighted version, which means it's better to be in the smaller members of the S&P than the larger members of the S&P until the chart tells you otherwise. So at this point, that ratio is still going higher. It's telling you at this point, not be in the mega caps and remain in the smaller part of the S&P. Folks, that is our show and a wrap for this week on The Final Bar. All of our previous episodes, including some fantastic guest interviews, from this week and previous weeks, all on StockChartsTV.com. So check that out, or on your mobile devices as well. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Have a great weekend. We'll see you on Monday.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're going to bring you daily content from an incredible collection of technical analysts and financial experts.